This is MPC 14 financial management. Block 3 financing decisions. Unit 10 capital structure. Now, you see in the balance sheet, you see when a company or small firm makes their balance sheet, on the right hand side are the assets, current assets, fixed assets. On the left hand side are the liabilities, current liability, then long term you see liabilities and capital. As far as capital is concerned, in small firms, you see they have to bring the money from home. In companies, you see they issue shares. You see, first whenever a company is you see big companies formed, they will give the advertisement in the paper, they will collect money from the public, you see 10 rupees share, then people will subscribe, then company will allot, then company will make first call, then company will make second call. Then you see when company receives the you see full amount of the share, initially you see they are in the primary market, then they are you see sold and purchased in the secondary market. Then company issues you see debentures also. By means of debentures you see company collects money and company has to pay interest on those debentures. Then company borrows money from the banks or from financial institutions. From the bank, when company you see borrows, banks are sanctioning working capital limits to the company. Banks are sanctioning term loans to the company. Banks are sanctioning guarantee issued limit, letter of credit limit. All these you see bill discounting, bill purchasing, all these facilities banks are you see sanctioning to the company. Now, how bank sanctions? Bank will, if suppose it is an existing company, bank will see the past 3 years balance sheet and future you see 2 years balance sheets or 3 years balance sheets, how you see are going to be their sales. And if it is a new company, they have only to submit the projected balance sheet to the bank. In the projected balance sheet, up to, if the credit facilities are up to 5 crores, bank only, there is a turnover method, bank only sees the you see sales, and up to 20% of the sales bank can sanction working capital limits for their day to day you see expenses for running the you see business. And then for purchasing assets, companies you see sanctioning them term loans. Demand loans also sometimes company sanctions. Demand loans are repayable in 3 years. Term loans they you see sanction for 7 years, 6 years. So this is all the part of capital. You see shares, debentures, then bank borrowings, etc. Capital is the backbone of any business. It is the financial foundation upon which a company's operations and growth depend. Every organization requires funds for you see 2 main purposes: working capital for day to day operation and long term capital for fixed assets investment and expansion. For buying fixed assets they need you see long term capital. Suppose when a company starts, they will buy land, then they will construct, they will need money for construction of the factory premises, then they will you see need money for buying machineries. All these are you see long term borrowings. For this they will do long term you see borrowings. And working capital for day to day expenses, how the company you see runs, say labor payment and electricity bill, then your raw material. So they are all you see they come in working capital. Now for working capital, as we have just now I told you that you see if you take if you put up your application to a bank, they will see your sales. The criteria is you see up to 5 crore of up to 5 crores limits. They will only see the sales and they can sanction you 20% you see of the sales as working capital. However, within this you see broader term, the capital structure specifically refers to the composition of long term sources of finance excluding short term liabilities. Capital structure primarily includes equity shares, then preference shares, then debentures, term loans and retained earnings. Debentures, in the beginning when you purchase debentures, they will pay you interest, fixed interest is paid by the company. Then of course term loans they can take from banks or financial institutions, and whatever is the profit, some portion of that they again reinvest in the business. Since short term funding requirement fluctuate frequently and are influenced by seasonal or operational needs, they are not considered part of the capital structure. Moreover, decisions related to capital structure are policy based, having long term impact on the company's solvency. A poorly designed capital structure can constrain business growth. Company may go into losses and it will not be, suppose it has taken financing, if some bank has financed, so it will not be in a position to repay the funds, and bank will consider that account, bank will declare that account as NPA, non-performing asset. If any account is not giving income to the bank makes it NPA, and then bank starts the process of recovering the dues. Bank calls back the money and starts, bank can file a suit also against the borrower. Then weaken investor confidence. Of course, if the company is not doing well, shareholders they will they will not take interest, and increase financial risk. While a well structured one enhances shareholder value and strengthens the company's market position. If the company is doing well, the share value of the company will go. Like you invest in Reliance, or there are so many other good companies. If you invest money in them, they will give you every year good amount of dividend, plus your share value will also increase. In essence, capital structure is not just about financing. Capital structure represents the proportion or mix of debt and equity. In a company's total capitalization, it is essentially how a company finances its assets and investments through various sources of long term funds. This mix may be from the bank, they can borrow money from the bank, from financial institutions, then by issuing debentures they can get money, and debentures they will be redeemed say after 5 years. So after 5 years company will have to give them back the funds. During these 5 years company will keep on giving them every year interest. Capital structure is not static, it requires active planning and periodic revisions. The aim of capital structure planning is to determine the right balance between debt and equity that minimize the cost of capital. Now suppose they borrow from the bank, that is how much interest bank is charging to them. Then debentures, how much interest company is going to pay to debenture holders. These are all the costs to the company. But once if they have issued the shares, that money will remain with the company till and those shares will be traded by the shareholders in the secondary market. Anybody can purchase, anybody can sell. Whosoever is having the shares, they can sell. Smaller firms often overlook formal capital structure planning and make ad hoc financing decisions. While this may work temporarily, in the long run it can lead to inefficient use of funds, higher financial costs and limited access to external capital. Capital structure also includes retained earnings which are reinvested, you see, profits rather than distributed as dividends, you see. These internally, you see, generated funds are critical as they reduce the need for external financing. In theory, the idea capital structure is one that results in the lowest weighted average cost of, you see, capital and the highest market value of shares. However, in practice, such optimally is difficult to achieve due to market, you see, imperfections. An appropriate capital structure aligns with the strategic goals of the company while serving the interest of various stakeholders, particularly equity shareholders, who are the ultimate, you see, risk bearers and owners. A good, you see, capital structure should enhance the company's ability to generate maximum return for shareholders, you see, dividend. This requires the judicious use of financial leverage, employing debt in such a way that the return on investment, you see, exceeds than borrowed funds. Then next is solvency. Solvency refers to the company's ability to meet its long-term obligations. Suppose now debentures are to be redeemed, you see, after 5 years. Company should, you see, generate money after 5 years so that they should pay to, you see, debenture holders. Excessive debt threatens solvency by creating fixed interest and repayment commitments. Next is flexibility. A flexible capital structure allows the firm to respond quickly to emerging business opportunities or threats. This includes the ability to raise additional funds without substantial cost or delay and to restructure financing. Next point is control. Control is especially important for closely held or promoter driven companies. Issuing new equity might dilute ownership and decision making power. Next point is risk balance. A good structure ensures that risk is well distributed among equity and debt holders. While equity absorbs residual risk, debt funds demand fixed returns. You see, companies must manage their risk. Industry alignment. Each industry has benchmark capital structure norms. For instance, utilities and telecom sectors tend to have, you see, higher debt. Next point is cost effectiveness. Minimizing the overall cost of capital is a central goal. Since debt is, you see, cheaper due to tax benefits and lower investor expectations. Next point is leverage or trading on equity. This refers to the use of fixed funds, debt and preference capital to increase returns on equity. When the return on assets financed by debt exceeds the cost of, you see, debt, it enhances earnings per share, that is EPS. Now next point is cost of capital. This involves choosing the mix of capital that results in the lowest overall cost of capital. Debt is generally cheaper than equity due to tax benefits. Next point is cash flow. The company's ability to generate sufficient cash flows is essential when deciding the level of fixed charge bearing instruments. Next point is control. A firm must weigh the impact of its financing decisions on ownership and managerial control. Issuing new equity dilutes existing shareholders' ownership and voting rights. To retain control, such companies may prefer debt financing despite its fixed cost. Debt does not dilute ownership as lenders do not have voting rights. Next point is flexibility. A good capital structure should provide the firm with the flexibility to adapt to changing financial requirements. Flexibility means easily raising funds when needed, redeeming or restructuring securities without penalties, managing a buffer of borrowing capacity for emergencies or expansion. A good capital structure with high fixed obligations can restrict operational freedom. For instance, if all borrowing capacity is exhausted, the firm may be unable to fund a new project or survive an economic downturn. Firms in fast growing industries or those undergoing frequent changes must emphasize flexibility. Next point is size of the company. The size of a firm significantly affects its financing choices. Large firms have better access to capital markets and can obtain low cost funds through a variety of instruments. Next point is marketability. Market conditions influence the timing and nature of security issues. If investor sentiment favors debt, companies may opt for debentures. Flotation costs, these are the costs involved in issuing new securities. Debt generally involves lower flotation costs compared to equity. Retained earnings incur no flotation cost. Capital structure is a vital aspect of financing planning as it directly influences the risk, return, cost of capital and overall value of the firm. It comprises a mix of equity shares, preference shares, debt and retained earnings. An appropriate structure considers profitability, solvency control, flexibility, market conditions etc. Now, what we have studied in this particular unit is, you see, about capital structure. Whenever a new company, say if suppose Reliance is forming a new company, first they will decide the name of the company, they will seek the permission of ROC whether that name is free, and if ROC gives them, you see, permission, then you see they will keep that name, and then first thing is they are going to issue the shares. You see, they will give a advertisement in the newspaper, then people will subscribe to the shares, people will, you see, give application money, people will, you see, deposit, fill that application form, include their, you see, enclose their check and deposit that in the bank. Now, suppose, you see, Reliance wants to control, you see, 10 crores by means of issuing, you see, shares. So, and if they have received the applications, say for 20 crores, now they will, you see, do, after that they will do allotment. You see, suppose somebody has been, you see, has applied for 100 shares, then they will issue to him 50 shares, you see. 50% they will do. Like this, you see, they will subscribe all the shares. After that, you see, they will collect first call money, then they will collect second call money, and all those people who could not, you see, pay these calls or allotment money, their shares will be, you see, forfeited, and they can be allotted to other people also. Now, like this, if they have, now they have collected the, you see, money, they will now, you see, start production after completing the formalities of the registrar of companies, and this is, you see, they have, this is the part of capital, and they have collected from the public by issuing the shares. Now, if suppose they want more, you see, money, so they will first prepare their projected balance sheets for future, you see, 3 years. They will submit those balance sheets to the bank. Bank will, you see, do a exercise on those balance sheets. Bank will work out the ratios, bank will see the sales. If bank is satisfied, and if they are under the rules of the bank, so bank will sanction them limits. So again, now they will get, you see, they can get term loans from the bank. Working capital also, you see, they will get working capital limits also, they will get from the bank. Similarly, they can, you see, request the bank for guarantee issued limit, you see, and letter of credit issued limits. Guarantee limits means, suppose, you see, they are one of their job is for this government contractor also, they are acting on behalf of, for they are doing the work of the government contracts, they are, you see, doing. So there they will need to submit this performance guarantees, and these guarantees are issued by the banks. And in these guarantees, you see, in the beginning, bank is not parting away with the money. Bank is only, you see, guaranteeing. Once if they don't fulfill, then this, you see, liability, this will become financial, you see, guarantee. Bank will have to give them money. You see, again, this is you see, debt only, this is a debt only. And similarly, they are issuing on behalf of the customer letter of credit also. Letter of credit means, suppose they are importing, you see, some particular item, that exporter, you see, bank, their banker will give a, you see, issue a letter of credit to the exporter's bank. In that, they will mention that if suppose this importer did not pay the money, bank will pay the money. So this is again, you see, a type of borrowing only. But these guarantees and letter of credits, they are in the beginning, they are not, you see, involving any money. Bank is not parting away with any funds. Bank is only, you see, promising. You see, bank is only promising. If their client does not fulfill the responsibility, then bank will pay. If their client does not pay, bank will pay. So now company can also approach to financial institutions also. You see, if some company is needing the more amount, then company can issue, you see, debentures. In debentures, company will have to pay the interest, you see, to the debenture holders, say every year. And say if the debentures are, you see, issued for 5 years, after 5 years that money they have to pay, those debentures will be, you see, redeemed, and they will have to, company will have to pay. So these are all, you see, capital. It is a capital for the, you see, company. And then by this, you see, capital, when the company gets, we took the example of a company floated by Reliance. When all these, you see, capital, now the company will start, you see, production. If the company may take some premises on rent or buy, you see, premises, if company is getting the loan from the bank, and then machineries, you see, fixed assets, these are all fixed assets. Then company will, working capital limits, by those limits company will buy raw material, engage labor and start production. So this is how, you see, it goes on. And then company will have to, you see, pay, service the bank's interest, or if they have borrowed the money from financial institutions, they will, you see, service the interest to the financial, you see, institution. So on the right hand side of the balance sheet of the company is the assets, and on the left hand side is the, you see, liabilities, and under liabilities capital is there. Then you see, as far as bank is concerned, they borrow cash credit limit, demand loan, term loans, bill purchased, you see, bill discounted. All these are the liabilities, you see, for the company. So now we come on the next chapter in this particular session. So in the summary is, capital structure is a vital aspect of financing planning, as it directly influences the risk, return, cost of capital and overall value of the firm. It comprises a mix of, you see, equity, preference shares, debt and retained earnings. An appropriate capital structure considers profitability, you see, solvency, control, flexibility, market conditions. Now you see, the capital, the company, they have to, you see, decide how much, you see, shares they will issue, how much money they should, you see, get by issuing debentures, how much they should borrow from the, you see, bank, and how much they should borrow from the, you see, financial institutions, etc. So this structure, you see, should be such that company should, you see, by these borrowings, company should be in a position to pay the interest to the banks, financial institutions, debenture holders, interest company should pay, to shareholders company should pay a dividend. And now all these things company will be in a position to pay if the company is going in profit, you see. So they have to plan in such a way, the capital structure in such a way that, you see, the expenses should be minimum. Then, you see, company can, you see, make profits. While theory suggests an optimal mix to minimize cost and maximize market value, you see, cost of the capital, they want that it should be minimum. In practice, decisions rarely heavily on, you see, human judgment and are influenced by, you see, company goals. Now we come on the next chapter, this leverage analysis, you see. Ratio analysis you must all be knowing. Financial analysis you must be all knowing. Then leverage analysis is nothing but a subset of financial analysis. You see, the ratios in leverages, few ratios they are in, you see, financial analysis. Leverage analysis focuses on understanding how a firm's financial structure influences its, you see, profitability, risk profile and overall performance. Now, a very simple ratio is, you see, current ratio. What do we mean by current ratio? Current ratio is, you see, current assets divided by current liabilities. You see, a company, a firm, small firm, medium sized firm or a large, you see, firm, this ratio should be, you see, more than 1. The most appropriate is 1.3, 1.3. If suppose, you see, your assets are less than, your current assets are less than current liabilities, you company will not, you see, do well. Next is, you see, your debt equity ratio. Debt means what you have borrowed, equity means your stake. You see, if this ratio is too high, say if this ratio is, you see, 6:1, 7:1, this means your borrowed funds are too much and your owned funds are, you see, very less, and it is not possible, you will not generate so much profit so that you can, you see, pay the interest on the borrowed funds. So, this ratio also, if it is 2:1, it is good, 2.5:1 is good. So, leverage. Then next is, you see, debt service coverage ratio. If suppose you have borrowed from a financial institution, whether you will be in a position to service the equated monthly installment or not, EMI you will be in a position to service or not, you find out by seeing this ratio, debt service coverage ratio. Again, this will, you see, this ratio will tell whether the company will in a position to pay, service the EMIs. Now, leverage analysis focuses on understanding how a firm's financial structure influences its profitability, you see, risk profile and overall, you see, performance. By taking out these ratios, you see, which are in leverage analysis, we can come to know about the, you see, profitability of the firm. Leverage essentially refers to the use of fixed costs, you see, both operational and financial, you see, to magnify returns. There are two primary types of, you see, leverage: operating leverage, operating costs like, you see, rent, salaries, depreciation; financial, you see, leverage, that is fixed financial charges, you see, like interest on debt. Both types influence the firm's earnings in different ways. The main aim of the unit is to explain the concepts, measures and implications of leverage, especially financial leverage, and demonstrate how changes in leverage impact return on equity, earnings per share and overall business risk. So, both types influences the firm's earnings in different ways. The main aim of this unit is to explain the concepts, measures and implications of leverage, especially financial leverage, and demonstrate how changes in leverage impact return on equity, dividend, you see, what company is giving dividend on equity, then earnings per share and overall business, you see, risk. Financial leverage refers to the use of, you see, borrowed capital, that is debt, to finance the acquisition of assets. It arises due to fixed financial obligations such as you see interest on debt. You see, suppose you have made borrowings from the bank, so whatever interest bank will charge, then your borrowings from the financial institutions like IDBI, and there are so many other you see financial institutions, or dividend on preference shares. You see, you have to service the dividend. You see, first you have to service the dividend on preference shares, then you service the dividend on other you see shares. Now all these costs, you see, you should be in so much profit, you should generate so much profit, so that you should be in a position to you see bear these costs. Now we are taking example of GTB Limited, which needs 80 lakhs for a project. If it raises all through equity, the return on equity would be 24%, you see. But if it raises, you see, 30 lakh from equity by issuing shares, 30 lakh it has, you see, raised, and 50 lakhs it has issued, it has raised from debt, that is borrowing from the bank, etc. And the rate of interest is 18%. So the ROE becomes 46%. The rise in equity return due to the use of debt is called, you see, financial leverage. It works because debt payments are fixed, and after meeting interest obligations, the remaining profits accrue to shareholders, enhancing their returns. However, this leverage comes with risk. If earnings decline, interest still needs to be, you see, serviced, you see, increasing the risk of, you see, financial distress. If suppose the company doesn't service the EMI or doesn't service the interest to the bank, if the cash credit account is, you see, overdue, bank will soon declare the account as NPA, and bank will start the process of recovery, you see, recovering the advance. And you see, by giving simple reminders, if the customer doesn't, you see, repay, bank can file a suit, or bank can take the possession of the assets also, and then bank can sell whatever. If suppose properties are mortgaged, bank can take the possession of the properties and sell the properties, and you see, recover the loan. Measures of financial leverage. You see, financial leverage can be quantified using ratios that compare debt to assets or equity. Debt to assets or equity. Debt to asset ratio is, you see, debt divided by total assets, and debt to equity is, you see, debt divided by, you see, equity. Let us say again example, Bharat Engines Limited plans an investment of rupee 1 crore and is evaluating different levels of the debt. The DA and DE ratios, you see, change depending on the amount of debt used. For example, rupees 80 lakh of debt, you see. So DA ratio is 80 divided by 100, that is 80%, and DE ratio, that is, you see, 80 divided by 20, that is 4 or 400%. These two ratios, you see, are mathematically related and can be converted into each other, you see, using the formula D oblique E is equal to D oblique A plus divided by 1 minus D oblique A. D oblique A is equal to D oblique E divided by 1 plus D oblique E. This is the relation between the two. This analysis helps firms understand how much financial leverage they are using and evaluate its intensity. Note that D ratio becomes infinite when all funds are raised via debt. Financial leverage can magnify profits as well as losses. It affects a company's return on equity and earnings per share. A firm earns a higher return on equity and earnings per share when earnings before income and tax exceeds the interest cost on debt. But if earnings before interest and tax is low or negative, financial leverage amplifies losses. Let's examine Bharat Engine's performance under 4 different capital structures with increasing debt levels 0%, 20%, 50% and each 80%. For each, the company experiences 3 economic scenarios: unfavorable 25% EBIT, favorable plus 25% EBIT, highly favorable plus 50% EBIT. So, it is unfavorable only if it is minus 25% EBIT. The findings show at 0% debt, ROE ranges from minus 15% to 30%. At 80% debt, ROE ranges from minus 111% to 114%. Earnings per share swings from minus rupees 1.50 to rupees 11.40. As debt increases, the sensitivity of ROE and EPS to changes in EBIT becomes sharper. This means higher volatility or risk in returns. Thus, financial leverage acts as a double-edged sword, enhancing profits when the times are good and deepening losses in when the times are bad in downturns. Now we come on operating leverage. Operating leverage arises from the presence of fixed operating costs in the business, such as depreciation, salaries and rent. Now, if suppose you buy machinery of 10 crores and the life of the machinery is 10 years. So, each year you have to put depreciation 1 crore. This is an imaginary figure but so that after 10 years the value in your books become 0. Salaries, of course, you have to pay every month. Then rent of the premises. It relates to the firm's business risk or the uncertainty in predicting earnings before interest and tax. Firms with high fixed costs and low variable costs have higher operating leverage. Now again example, 3 firms are there, ABC, each selling at you see rupees 10 per unit, but the different cost structures are. For May, you see lowest fixed cost is, you see, rupees 15 lakh, highest variable cost is, you see, rupees 7 per unit. Firm B, moderate fixed and variable costs. Firm C is, you see, highest fixed cost is 4.5 lakh, lowest variable cost is rupees 4 per unit. Using the degree operating leverage, you see, formula, degree operating leverage is equal to percentage change in earnings before interest and tax divided by percentage change in, you see, sales. If firm C increases sales from 80,000 to 90,000 units, a 12.5% increase, profits, you see, sale is increased by 12.5%, profits rise by, you see, 160%, showing, you see, very high, you see, operating leverage. On the other hand, firm A's profits rise only by, you see, 26.7% for the same, you see, sales increase. Now, what are the implications of operating leverage? High operating leverage, you see, magnifies profit changes. Firms with high DOL must achieve, you see, high sales volume to remain in profitable, to remain in profits. Such firms may opt for aggressive, you see, pricing strategies to boost, you see, volumes. So, high operating leverage magnifies, you see, profit changes. Firms with high DOL must achieve high sales volume to remain profitable. Such firms may opt for aggressive pricing strategies to boost volume. Combined leverage. Combined leverage is the total effect of both operating and financial leverage. It shows how a change in salaries, you see, how a change in sales affects net income of earnings per share. It is calculated as DCL is equal to DOL multiplied by DFL, where DOL is degree of operating leverage, DFL is degree of financial leverage. So, combined leverage is the total effect of both operating and financial leverage. It shows how a change in sales affects net incomes or earnings per share. It is calculated as DCL is equal to DOL multiplied by DFL, where DOL is equal to degree of operating leverage, DFL is equal to degree of financial, you see, leverage. For example, Bharat Engines with 80% debt experiences a DFL of 1.92, that is 10% rise in EBIT, leads to a 19.2% rise in net income. In contrast, with only 20% debt, DFL is 1.14. A higher DCL means higher risk and return potential. Hence, firm with high operating leverage should ideally, you see, maintain low financial leverage. So, Bharat Engines with 80% debt experiences a DFL of 1.92, that is 10% rise in earnings before interest and tax, leads to a 19.2% rise in net income. In contrast, with only 20% debt, DFL is 1.14. A higher DCL means higher risk and return potential. Hence, firm with high operating leverage should ideally maintain low financial leverage. Now financial leverage and risk. As leverage increases, business risk also you see rises. Risk here is the possibility of variability in returns due to changes in economic conditions, sales or costs. Risk can be statistically measured using the coefficient of variation. Coefficient of variation is equal to standard deviation divided by mean return. As debt you see rises, CV rises significantly, showing greater volatility in returns. Hence, leverage must be used strategically, balancing return maximization with risk management. Now, based on Bharat Engine's performance under 4 different capital structures, we find that debt percentage 0, then ROE is 13.5%, standard deviation is you see minus 1.57, CV is you see 1.163. So, these are the results you see. Now, financial leverage, use of you see debt to enhance returns on equity, effective only if return on assets exceeds the cost of debt. You see, operating leverage, use of fixed cost in operations. High DOL means higher business risk and sensitivity to sales you see changes. Combined leverage multiplies the impact of sales fluctuations. Leverage amplifies you see both profits and losses, increasing return potential and financial vulnerability. Proper leverage planning depends on the company's you see industry, sales and stability, cost structure and risk appetite. Coefficient of variation CV is used to assess leverage related you see risk. Now, there are you see I have made you see formulas here, I have listed formulas here. Debt equity ratio is equal to debt divided by equity, DA ratio is equal to debt divided by debt plus equity, DOL is equal to percentage change in EBIT divided by percentage change in sales, DFL is equal to percentage change net income divided by percentage change in earnings before interest and tax, DCL is equal to DOL multiplied by DFL, then CV you see stands for standard deviation divided by you see mean. So, students, we are closing this session. Thank you very much.